Hey everybody, it's Jeff Gibby over at Metastock. Hope you're having a really, really good day. Uh, we've gotten cold. It's like 11 degrees here. I'm not ready for that. Anyway, thanks for coming today. I hope you're doing well. Let's go ahead and read the legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and the accompanying software guide plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So glad we got through that. I do want to spend a second to introduce our guest speaker, Nick Capaccio. Nick is here for his very, very first presentation in the Metastock room. We're very, very curious to see it. Actually, let's go ahead and bring him in here. Hello, Nick. How are you today?
Great, Jeff. How are you?
I'm doing very well. We can hear you, which is always a good start, right?
Excellent. Yep.
All right, good. Is there anything in particular you wanna you wanna tell us about yourself?
Sure. I started trading back in first trade I ever made was in like 1978,
I
which
was
is a while ago. I just gave away my age.
I was
And
4 years old at that age. Or-
yeah, and yeah, I would trade through strictly fundamentals, and then I started to get into technical trading. And once I got into technical trading, I had so many different of my friends and different clients that I was dealing with didn't understand technicals very well, and it was too hard to explain. So I decided to build the Endeavor program with Ryan to simplify everything and make it a lot easier. So it helps everyone identify stocks very simply.
Perfect.
So that's where we are now. And I do trade every day on a professional level. That's how I make my living. And yeah, so we're ready to go.
Yeah, I just sent the screen control over to you, so it should say somewhere on your screen, click here to share your screen or something along those lines, and I can see it. The
All right,
audio is coming
great,
through great as well, so
great.
I'm gonna go ahead and get out of your way.
All righty. On- Okay, as Jeff had mentioned, my name's Nicholas Capaccio, and I'm the co-founder of Simplicity Trading Systems. Yeah, most people call me Nicky C because it's so much shorter than Nicholas Capaccio and it's just so much easier to remember. I'm also executive managing partner of Capaccio Trading Company, and that's where all our trades are placed through. I do trade full time. It's the way that I make my living and my career. So we have Simplicity Trading System is where we developed the Endeavor program, and all of our trades that we take come from the Endeavor program, and then we make the trades through the Capaccio Trading Company. So that's a brief history of what we do, and we'll get started here. Endeavor was created to help simplify trading for the average person, as well as the trained professional trader. It's a guide to help understand where the stock, the equity is at the present time, so you don't react to stock movements. You're more prepared for when they're going to happen. Now we use different signals, and each signal is shown by a color code.
The broadcast is now starting. All attendees are in listen-only mode.
And we start with the green signal, which is a long-term trend. And then we have a signal that is the blue signal, which is a short trend, term trend. And then the black signal, which is going to show you when a stock has reached a high and pulled back and possibly wants to rebound somewhat towards the high again. Um, these signals create an environment for how you're going to trade because we call it let the market come to you. Don't go to the market. You need to decide before you ever make a trade, are you going to be buying for long term, short term, or very short term back to a recent high? Those are the decisions you need to make before you make the trade, and the system will identify those for you. Now, we also have what we call smart get outs, which has an early warning signal, which is a dip in price. Now, a dip in price does not necessarily mean that the stock will break down. It's just going to take a little dip. It could be on a nice trend moving up. It's going to take a little pause for a while. You might want to use it to maybe exit a trade if you're up quite a bit. You may be in it for a long-term trade and say, I'm just going to hang on to this for a little bit. I know it's going to dip in price, but there's no threat for me to get out of the stock. And then we have the exit signal, which the exit signal is a potential breakdown in price where the stock will start to break down. Now, all these signals are available at stwhatsendeavor.com/e with videos to explain them all. And what we are going to be talking about today is how to predict when price will make a 15% to a 20% upward movement in 6 months or less. Now, this is a long-term trade, and that's what our green signal is designed for. This is to say, okay, I'd like to make a trade into a equity, and I'm looking to do this for a longer term. I really don't care about a 1 week trend or a couple day trend. I want to see if I can get the most profits out of the equity, and that's what the green signal will predict. Now, before we get into the signal, we need to identify the big picture movement of any equity, because if you don't understand the big picture movement, what's happening, it's very hard to understand how the stock could possibly trade. Now, to do this, you may ask, well, how does this all work? Well, after you select a security, we categorize its price as Endeavor or Discovery. Now, Endeavor is potential upward trends that could reach their all-time highs. Discovery is potential downward trends with consolidation at their lows. So if we're looking to go into a trade for long term, we don't want one that's on a downward trend. We want one that will become out of a downward trend into an upward trend. And that's what Endeavor does. It's potential upward trends that could reach their all-time highs. Now, the way we start this is we put a symbol in the power console, Metastock. This particular symbol is TIF. Now, this is not selected for any special reason. It just happened I chose this one here to demonstrate Discovery and Endeavor. Okay, when you put a ticker symbol in, there's going to be a ribbon that'll appear at the bottom of the chart, which we just marked right here for you. And you could clearly see Discovery is a downward trend and Endeavor is upward trend. Now, what we have also added to the chart, and this automatically comes when you apply the ribbon, is the 100-day simple moving average. And this is very important. And the reason for this is not the go-to for everything. It's just a simple way to identify if a stock is in a downward trend or if it becomes ready to go up in an upward trend. And oftentimes you can get tricked with stocks because at this particular time, the stock was in a downward trend. We can easily see it was moving down. Well, here's that consolidation at a low, because remember, Discovery is a downward trend with consolidation at a low. Well, this is where you could get tricked. Now, the stock decided to make its way up, and it even went above the 100-day simple moving average. So you may be thinking, wow, it's a great time to get in the stock. No, it rolled back over and went back into consolidation. You can clearly see that. And oftentimes stocks will do this. So what you don't want to do is get in here and have it roll back on you and then lose your money or panic and get worried about it. Now, Discovery is a downward trend. Endeavor's upward trend. So we the stock ever. Now, also, the important reason of the 100-day simple moving average is if we cut this chart off right here and we couldn't see moving to the right, you would think that the stock here may have been ready to make a move up, especially on this bar. You might think, well, this is ready to go up, but you can see the 100 simple day is still coming down. So we want to stay away from that. That's why the 100 simple day is so important. We like to use it so much. Such a good guide. Okay, now, as I mentioned before, when the stock is in a downward trend, you'll find some consolidation usually. It'll try to make its move up. And here, in this particular case, it moved over. We want a system that's not going to tell us to get in here to get burnt on the downside. We want our system to be able to tell us when the stock is ready to go into endeavor for the long-term trend. And that's what we're going to look at. Potential upward trends that could reach their all-time highs. Now here's a little fun fact. Every stock that has ever exceeded its all-time high has done so while it's in what? The endeavor category. Of course, that's what it's designed to do. A stock cannot reach its all-time high when it's in discovery. So to recap, discovery, when you see this ribbon on the bottom of your chart, is a potential downward trends which consolidate at lows. On the other hand, endeavor is potential upward trends that could reach their all-time highs. Now let's get into our green symbol, because our green is going to show us when a stock is going to come out of endeavor and go into, or come out of discovery and proceed into endeavor. And we want to make sure that we have a signal that can tell us, okay, this is ready to make its move. So let's see what the green explains to us how it'll work. Green signals represent price building strength after transitioning from major lows. Okay, price is likely to develop an upward trend that can last for months to years once confirmed. Okay, that's the trade we're looking for. 3 consecutive closes above the trigger point, and we represent our trigger point with the initials TP, are needed to confirm the signal. Okay, sounds simple enough. Color icons mark the confirmation bar and identify the strength of the trend. Okay, that's all pretty simple. Sounds simple. So the first one is the green 3, which is strong strength. The next icon, strong strength, means price has the potential for a long-term trend. The next icon is yellow. This is weak strength. Extra confirmation is recommended. A manual watch for price to have at least 3 consecutive closes above the confirms bar high. Okay, that's giving us a good warning. It's letting us know, let's not jump into the trade quite yet. We need to have more confirmation. And red is no strength at all. This is going to let us know that the price has become overextended and the trade is not recommended. Now, it's very simple to remember these color codes. It's the same thing as a stoplight. You've got green for go, you've got yellow for caution, and red for stop. So we use the 3 colors that represent that. Now, to bring this a step further, and enough of the trying to explain exactly how it works, we're going to jump into Metastock, and we're going to see some actual stocks and how they're going to progress in green. Okay, now the first stock I have here for an example is Apple. And everybody's familiar with Apple. And there's a lot going on in this chart right now. So what we're going to do is we're going to take it in sections. The very first thing that you're going to see appear on your chart when we're coming out of discovery, which is the light gray, into endeavor, is going to be a green arrow. Now, since we have the green arrow, we don't just jump in right away and say, oh my gosh, I got a green arrow. I could get in this trade for long term. That is not what the green arrow represents. The green arrow is representing it's time to take a look at this stock. We need confirmation, but it's time to take a look at it and see if the stock can possibly become a long-term trade. Now, so I don't have to backdate the chart here. I'm just going to bring up back when we got the arrow, it was right here. Green long-term. And when we go up to our commentary, which Metastock is excellent with the commentaries, it tells us of our description about green and what could possibly happen. And then it gives us a trigger point. Remember we spoke about the trigger point, the TP? Well, the trigger point happens to be 188.99, and that's represented with a line right here. Now, as soon as we see the green arrow appear on our chart, the first thing we do, and this is going to appear in the evening, the first thing we do is we go to the commentary and we get the trigger point, because that's going to be a guide for us. That's all we do, is we go get our trigger point. Then we wait. Now we know we need 3 consecutive closes before we're going to get an icon. So the next evening, you don't even have to look, because it's evening number 1, and then you have evening number 2. Evening number 3, you may want to start to look at the close of the day to see if we got the icon. In this particular case, here was our green arrow. Here was our trigger point of 188.99. We get a close here, which is positive and above our trigger point. The next day we get a close. The third day we close below the trigger point. Make that easier to see, for you to see. We close just below the trigger point. We close at 188.74, not 3 consecutive closes in a row. So we go the next couple days and we move around, and then all of a sudden, boom, we get a close. Next day we get another close. Third day we get a close in a row. Now these are individual days. These are 1-day bars. There's our 3 icon. That's what we're looking for. Now it's a green 3, which means we have strong strength. Now, do we jump in the trade right now? Not yet. What we do is we go to our commentary and we get some important information. We could ignore our trigger point because we already crossed our trigger point and we got our 3 consecutive closes. What we'll do is we already know we have a strong strength. Price has the potential for a long-term trend. So we scroll down, and right here is what we're really after. For a long-term trade, use 164.65 as a stop loss and risk estimate. You can see I put it on the chart right here. I always put the risk on my chart, and it's very important that we do this. Trades with the risk above 16% are not recommended. Okay, that's given us a good clue. Estimate risk from the confirmation bar is 15.14%. Okay, it's below 16%. It's a little high, but it's below 16%. Now, if you happen to say, well, you know, I know Apple pretty well. It's a pretty good company. I don't think they're going to go out of business or anything anytime soon. So I'm willing to take that risk to take this trade to make potentially 15 or 20%. Okay, so this was our trigger point, and it helped guide us. So every night when we take a look at our 1-day bar, we could see if it closed above or below it. So since we've already established that, we're going to delete that because we don't need it any longer. It did a great job for us. Now we see here, we put on our chart the 164.65, that's our minus 15.4% loss, stop loss. Now we're going to go after our new trigger point. When we have the green icon, we go by the day's close. I'll repeat that. We use the day's close. In this particular case, it was 194.02 as our trigger point. Now we have a new trigger point. Now we need for the stock to show us that it wants to exceed this trigger point. Now, what I like to do, and it's just the way I trade, is I also like to see the stock exceed that day's bars high the next day. So this high was 194.46. So just because my trigger point's 194.02, I'd like to just be cautious and have a little extra cushion and say, let me see this take out the price by 10 cents. Well, the next day it clearly takes it out by 10 cents. So do I jump in full boat and say, hallelujah, I'm going to make so much money on this trade? No, I take a third. I only purchase a third of what I want to invest into this equity. Why am I going to purchase a third? The reason for that is it's a long-term trade. A lot can happen. There might be a little bit better buying opportunity for me to get in at a better price even. I may, if I'm going to lose on the trade, don't lose my full boat of money. I just lose a third of what I wanted to truly invest. So I'm going to be patient and I'm going to wait for the market to come to me. I never chase the market. So we can see that Apple starts to move up. It's got a new move up, good move up. And it comes up here, and for some reason, it decides to turn. And it comes back down. Now you can see as it comes down, where did it find some support this one day here on 510? Right on our trigger point of 194.02. It tagged it and it bounced up. Well, that's a very good sign. But unfortunately, some bad news or earnings, something happened here, and the next day it gapped down. Okay. Now, do we panic? No. We're confident in our trade. We know what our stop loss is. The stock trades sideways and boom, comes down again. Now, do we sit here and get all worried? Absolutely not. And why is that? Because the initial time, when we initially took the 1/3 in this trade, we said we have a stop loss at 15.4%. And that we know that losses could possibly be there. So we're not going to panic. We're going to say, well, I only have a third of my money into it. I'm willing to see how this trade goes. So all of a sudden, the stock turns around and it comes up. Well, right here, came up above our 100-day simple, but it did not close above it. It closed right on the 100-day simple. Do we jump back in? I don't like to. I like to wait for the next bar to take out the high of the first bar above the 100-day, and then give me a positive close. You can see we close at the top of the bar. Great, great close. This would be a nice time to say, I think I'm going to put in another third into this stock. I'm able to buy it lower. It did not take me out of my stop loss, and it's going to looks like it wants to start to trend up, and trend up it starts to go. So what does it do? It comes up and it consolidates. Guess where? Our trigger point. Wow. How did it know to consolidate back on 6/12, June 12th, from a trigger point from 4/2, from April 2nd? That's what it did. It's a very good sign. So it starts to make its journey back up again. I don't know what happened here. We had some extremely large bars and boom, it sinks. Okay. Do we panic? Nope. Do we get all frustrated? Nope. What did it fall and find support on? The trigger point. All the way back, all the way up forward here on 8/6, found support on that trigger point again. That's amazing. Now we get a close above the 100-day simple again. I don't like to take an inside day bar. An inside day bar is a bar that doesn't take out the high or the low of the previous day. I don't like to take a trade in that section. I wait for the next day or so until we get a bar that does exactly what the next day did. It took out the high of the inside day bar and the previous day's bar, close at its high. Boom. It's time to buy another third. We're in this full boat. Stock comes up, bobs around, comes up, and right here on 9/11, what does it do? It gives us our 15% profit. 223.12 is our 15%. Now, as soon as this happens, half of my position gone. No question about it. Out, gone. I lock in my profit. I lock in 15% on half of my trade. Now, if I could not get out here because it happened to close right at the top, right at our money, and the next day comes and gives me an next opportunity. I missed this day here, 9/11. The next day was 9/12. If I didn't get out here, I'm gone right here. I take the money and I run, put it in the bank. We're in business to trade, to make money. We take our profits, put them in our pocket. All right, the stock decides to trade sideways, bobs around, comes up here, gaps up this day, takes out our 20%. 232.82, I'm gone. My other 50%, gone. In my pocket, I'm out. Now, do I sit here and say, I coulda, woulda, shoulda, hung on longer because the stock continued to go up? No. Why don't I do that? It's very simple. Back in April, when I got in this trade, I was looking to make 15 to 20%. I can't now get out here and say I coulda, woulda, shoulda, because I'll show you what happens to a lot of stocks if you coulda, woulda, shoulda. You'll get burnt. Now, Apple, it's a great company. It could continue on to who knows where. The sky could be the limit. I don't know. But I do know this. I've got between my buy here, between my buy in here, and between my buy in here, and between I get out half at 15 and half at 20, overall, I'm just about at my 20% clear profit. I'm a happy guy. I'll go on to the next trade. Now, in my next example, I'm going to show you why it's so important to be disciplined. And if you come into the trade knowing you want to make a certain amount of money, the 15 to 20% is what we look for in a green, a strong green, why it's important to be disciplined. Let's look at our next trade here. This is DISH, symbol DISH, okay? And here we had a green arrow back on 4/10 of 2019. So I'll go back to the day we had the arrow. I'll come up to view. I'll check my commentary. 34.68 is my trigger point. I'll put my line in 34.68. Okay. Now let's go back to our full chart. Here's our trigger point, 34.68. Remember, we need 3 consecutive closes above the trigger point to get the icon. And we got a strong strength here. The stock bobbles around for over a week, back and forth, but does not give us 3 consecutive closes. Well, there's 1, 2, and right here on 4:30 was our third. So we finally got them, but patiently waited out. If they never come, they just don't come. We move on to another stock, but we did get one. So I come up to my commentary. We take a look. For long-term trade, use 30.90 as a stop loss. There's my 30.90. You have the potential to lose 12.01%. Do not take a trade above 16% risk. I'm below it. I'm willing to take this trade. Let's see what happens. The next day, remember on the day of the icon, we want to be 10 cents above the high, 35.46 was the day that we got our icon, our 3. So we got to go 10 cents above it. Well, the next day, we don't. The high is 35.48, a couple pennies, not in the trade. The next day, trades down. Glad we're not in it yet. And the following day, we pop up to 35.69, which takes out the high of 35.46 by 10 cents. I'm in it 1/3, buying 1/3 of the shares, and I'm comfortable. Now the stock, I'm going to back up here a minute. I don't mean to confuse anyone, but our original trigger point, I always like to take that off my chart once it's done its job for us until let us know that we had our 3 days above it, the price. I like to put that line in so because it's hard to look back here and see if I had a close above it. It just helps guide so much easier. Okay, so I buy a third here. Stock bobbles this day. Oh my gosh, look at boom, all the way down to 31.01. Pretty close to 30.90. Almost lost the third. Did I panic? No. Why? Because I knew going into it, that was my risk, 12.01%. I know it going in, it's no surprise. Fortunately, this came back up, closed above the simple, the 100-day simple. Remember that 100-day simple? Bobs around a little bit, finds great consolidation again on that trigger point, that forever trigger point. And the first day that a bar comes and tops all this consolidation and is 10 cents above that trigger point, boom, another third comes in. Now I'm feeling good. I bought a third back here. I buy a third here. Do I go in full boat here? No. Don't want to lose all my money. Being cautiously trading, it's a long-term trade. Well, what's the stock do? Takes off. And right here on 6/18, we hit 15%. As soon as the stock comes up and takes out 40.38, what does Nicky see? He's gone. Half my position's gone. Even though I never got another opportunity to buy my other third, half of my shares are liquidated. Now, why did I not buy another third anywheres in here? Because I'm not going to chase the stock. The market has to come to us. If we chase the stock and we overpay, then if it does come back down and take us out, we really lose a lot of money. We don't want to do that. So if I only bought a third and a third, I'm comfortable. It's not my last trade I'll ever make. I'm happy. So stock continues its way up. And right here on 7/16, the high is 41.10. I'm sorry, 42.10. The 20% is 42.14. Now, do you get out or stay in? Well, I'll be honest with you. If you're 4 cents away to 20%, I'd be gone. I'd say goodbye. I'm out. Well, unfortunately, I missed this day and I never even looked at it. So shame on me. Stock comes down, comes back up right here the next day or a couple days later, 7/22, and the high is 42.11. I'm gone. I was 3 cents from my 20%. I'm out. I liquidate the rest of the other half of my shares. Now, this is why when you go in with a game plan, you want to make 15 to 20%, and you reach that mark, I like to get out because the next day it gaps up and boom, and then boom, boom, boom. All the money's gone. I don't want to be in that. I'm pretty happy. You know where my money was? In the bank. I didn't have to put up with any of this mess because this was bad. And believe me, folks, when you're in here and you get greedy on this and this starts to happen, you'll say, let me give it one more day. It drops down. You say, well, it didn't go. I'll give it one more day. And it keeps legging itself down. Before you know it, you lose your money. So we want to make money on the trades, not lose money on the trades. Okay. Now, the next example I have is really going to define discovery and endeavor to you in a really good way. There's two companies here. One is Walgreens, and the other is CVS. Now, Walgreens and CVS, I'm sure we're all familiar with these two stores, retail stores. Their footprint is almost exactly the same in each store. If you go into a Walgreens or you go into a CVS, they sell the same type of product. They have same size stores, basically within 1,000 square feet. If you're in a large city or bigger populated area, if there's one right across the street, you'll have the other one. They just tag team each other. Now, as we can clearly see, Walgreens is in discovery, and it's been in discovery since January of 2019 up until today's date, 10:30. That's a long time. But look what it did in discovery, exactly what it's supposed to do. It was in endeavor, it was going up, it reversed, came down, consolidated, boom, consolidated, boom, consolidated, and just struggling along in consolidation. That's what discovery does, a downward trend, and then goes into consolidation. So it's doing what it's supposed to do. We just don't want to be in this trade because we can get burnt at any given time. We don't know if it's going to keep going down again. We don't know what it's going to do yet. Now, on the other hand, CVS came out of discovery and went into endeavor. And this is September, October of this year. And there was our arrow. So let's go back and see what we do when we get the arrow. Come back where the arrow came on the date, 8/22. We're looking at our commentary. Gives us the trigger point, 62.17. Put our line in there. You know what our trigger point is. We know we need 3 consecutive closes above it to get in. And look what happens. We don't get them. 1, 2, 3, 4, 5, 6, 7, 8 days go by. That's a long time in the stock market. We don't get it. We're not in this trade. Even though we've got our signal, we don't have the icon yet. So then we get a close above the trigger point, a barely closed above the trigger point, but it did close above it. And we get a close above the trigger point. And what do we get? A green 3. And this is the strong strength one. Okay. Now we come back. Let's check the commentary. For long-term trade, use 55.22 as our stop loss right here. The risk is 13.28%. Put it on our chart. Trade has to have a risk above 16%. I mean, don't take a trade if it's above risk higher than 16%. Well, we're below 16%. So we're going to think about taking this trade. Now, here again, I always put on my chart my stop loss with the line down in the sand where it's going to be, and reminds me of my loss, because I don't want to panic in a trade if the trade does start to go south on you. You don't want to panic. You knew going into the trade this was your risk, so you keep it there so it reminds you. Day one, I knew what the risk was. There's no shock. There's no surprise. So you accept it, or you don't take the trade. Now, the next day after I get the icon, remember what we go by. The high of the bar is 63.86. The next day, obviously, the high is 64.12. We took out the high. What do I think about doing? Buying a third. I buy a third. Stock, well, before we go any further, the original trigger bar, since it did its job for us, let's say goodbye to it. Stock's bobbing around, bobbing around, bobbing around. It's consolidating on that trigger point. I don't know how it over knows it, but it just knows it consolidates on that. The algorithms are working for us. And then it starts to come down. Now, a very good buy-in, because we never got down to our simple 100-day simple. We never have gotten close to our stop loss. This is a very good day to buy in another third right here. Why is that? Because this bar, the day prior, we exceeded the high with a positive close. If you're thinking about buying another third, I would say that's a pretty good time. Now, could we have bought another third right here? Yes. Would we have bought it here? No, because this is an inside day bar. Remember, an inside day bar does not exceed the higher to lower the previous. I want to see above this bar and the inside day bar, which was here. So let's just say we would have bought a third right here on this bar, 930. It's okay. It's not as good as here, but we didn't know it was going to go here. So you're still below your original trigger point. So it's fine. So this was a nice time to be able to buy this. Now the stock starts to come back up. And what does it come across? Trigger point. There's a great time to buy the other third, last third. Now, because we don't know where the stock is going to go yet, we haven't seen the future, I put my 15% here and I put my 20%. So it reminds me, so is the stock, if we're fortunate enough, if this particular stock, CVS, wants to continue its journey up and give us our 15 and our 20%, as we're moving up, I could put the lines on the chart and then I'll adjust this and move this up to my lines. So right now it looks like it's having a good journey. Do you buy this stock right now? Absolutely not. Why? Because you'd be chasing it. You're chasing it, starting an uptrend. You never, ever chase the stock. Always let the stock market come to you. I can't stress that enough. I have so many friends of mine through the years. All they did is bought the high and then sold the low. They just never got understood it because they chased the market. They heard the news, they heard an analyst, and they chased the market, and they ended up always getting in trouble. So let the market come to you. Be patient. This isn't a race. This is not a race to the top. This is to secure your earning, your winnings that you get on a trade. You want to lock it in. You want to put the money in the bank. All right. Now let's look at something that we should not do. That could be very tempting, but we don't want to do it. This is symbol SFIX, Stitch Fix. There's a green 3 icon, strong strength. There's our green arrow. Here's our 100-day simple. What did this stock do? Came up. It clearly took out the high of this bar by 10 cents. Everything looked good, and it collapsed. Totally collapsed. Now, before we say, well, it didn't work that time, you're right, it didn't work if you said that. But I want to see what my commentary said. For long-term trade, use 23.81 as a stop loss. Risk. Okay, we know that. Trades with the risk above 16%, not recommended. This risk on this bar, particular stock, is 23.18%. There is no way, I don't care who it is, I would take a risk like that, and I don't believe any of you would. It's above 16%. We don't even bother taking the trade. You know what we say? Next. Not interested. Goodbye. We don't want this stock at all, because all that's going to do is going to fry us. The risk is too high for the reward. No way will we touch it. Okay, now what we're going to do is I'm going to show you an example of a change in strategy and a yellow. Because remember, the yellow was caution. The yellow said weak strength, extra confirmation is needed. Right? Remember that? When we first started, we talked about the yellow is caution, and it has to prove to us. The stock must prove to us that it has enough strength to give us some profits. So let's go back and look at the day when we got the arrow, back on 2/12 of 19. We go to our commentary, and I'm only going back like this so I don't have to backdate the chart for you. Our trigger point was 114.50. We apply it on the chart. like we always do. Let's go back to this live chart here. Okay, here's our trigger point. As we move along and we're bobbing along and bobbing along, remember on a yellow, now we need 3 more closes above the high of the icon bar. We need 3 closes above the high of the icon bar. Okay, so this trigger point, even though we have 3 closes above it, it helped us and guided us so we could say goodbye to this. But with a yellow, we need more confirmation, right? Weak strength, extra confirmation. Now, if we look at our commentary also, I think I forgot to show you this. It says extra confirmations recommended here. Manually watch for a price to have at least 3 consecutive closes above the confirmation bar's high. It's telling us, it's warning us, it's doing us a favor. There's no guessing. So here's our confirmation bar. Our high is 116.64. That is our trigger point, and we need 3 closes above it. Well, look how it's consolidated. Doesn't matter, we're not in the trade. Right here, 318, we get a close. Next day, close. Next day, a close. There's our 3. Now, on this particular stock, and this is Pepsi, PEP, we know Pepsi's a great company. We know they're not going to go out of business tomorrow, hopefully. I'm going to revert back to the commentary. I'm going to show you something where I changed my strategy. For a long-term trade, use 110.14 as a stop loss. There's my 110.14, $110.14. And you must be very accurate on this. You must put your senses in. Everything's got to be there. We know we're not going to take the trade if it's above 16%. The estimated risk for the confirmation bars, oh my gosh, 4.92%. This is golden, folks. This risk is very, very, very low for a long-term trade on an excellent, excellent equity. So we'll close our commentary right here on this next day. We take out the high of that third day's close by 10 cents. I went in full boat, 100%, no third. With such a low risk like this, my strategy now turns, because now I'm saying I can accept losing all the shares that I wanted to put in, all I wanted to invest in this company at this time, to take a risk of so low. I'll take this risk all day long to make 15 and 20%. I won't buy thirds. I'm going to go in. What's the stock do? Comes up, travels up, travels up. Boom. 134.13, 15%. Half my shares gone. No question asked. Half are gone. Will not hold on to all the shares. Stock bobbles along. As you see, it never gave me an opportunity to jump in. So if I only would have bought a third here, it would have been okay. There's nothing wrong with that. You're making money. You won't make, all as much as you thought you'd make. You're still going to make your 15%. But it never gave me a buying opportunity. I just got a little lucky here. I saw the risk was low. I'm going to go in all the way. Now the stock rotates, turns around, starts to come down. Well, there's that 100-day simple that we like so much. It consolidated here. Consolidated up. And you could see this is an inside day bar. And then this bar came and it made a nice push up. And then the following day comes up above that 100-day simple. That's a very good sign. And then it makes its journey up. And what's it do? Boom, hits the 20%. Gone. The other 50% of my shares are gone. Now, could you have sold here? The other 50%, of course. The high was 139.18. We're looking for 139.96. Of course, you take your money. You could take your money and run there. You could have taken your money and run here. I happened to get lucky enough and I took it here. It was gone. There's today's date, out of the stock. Now this stock can go up forever. Doesn't matter to me. I got my money in my pocket and I did what I wanted to do. I was looking to make my 15 to 20% and I was able to make it. All right. Show you one more example here of why you watch for the three closes when you have a yellow. Here's LVS, symbol LVS. It's Las Vegas Sands, another good company. Here's our icon, green long term. This was the trigger point. Now remember what we need on a weak strength. We need 3 consecutive closes above the trigger point. There's 1, there's 2, but I don't see 3. Boom, down it came. Isn't that amazing? Because we need to patiently wait, we didn't get tricked into this and it just rolled and shot down so hard. Now, yesterday, we got a green arrow. So now we can go check the commentary. Check the trigger point, 62.26. And we wait. And let's see if we get an icon. We may never get an icon. We might get an icon that's a yellow and we need more confirmation. We may get an icon that's a red and we don't take the trade. But if we do get an icon, we need to check the risk. Never take a trade over 16% on a long-term trade. And the reason why I have to go 16%, because I would never take a risk of 16% on a short-term trade. The reason why we have to take that higher risk level like that is we have to let a stock mature into the 15 to 20%. And that could take a little time. And we know that going into the trade. We absolutely know that. Now, one more example before I turn this back over to Jeff. Here's a no strength, not recommended. This is iRobot, symbol IRBT. This was back on 212. Now, this is a no strength, not recommended. Okay, and this is a double whammy here. We know we're not going to take that trade, but just out of curiosity, let's check our risk factor. 29.05%. No, thank you. Goodbye. Off my screen. Never look at it. Now, I'm not saying I'll never look at it, but I'm not going to look at it under these conditions. And what did that trade do? Well, I didn't make the trade, but what did this stock do? Came down, leg lower, traded sideways, down lower. It's in discovery now. Now, one day it'll come out of discovery. We'll get maybe a green icon. The risk won't be ridiculous. We may trade it, but now's not the time to trade. All right. Well, that ends the examples of the green. I truly appreciate everybody coming and following and watching. I hope this was educational to everybody and you learned a little bit about it. I am going to turn this over to Jeff and he could explain about pricing and all, and we will also take some questions if there are any questions for us.
Okay.
And Jeff, would you like to take over?
All right, Nick. Great job. Very good first demo.
Thank you.
We did have a few questions that came in, but we were able to answer them. So.
Oh, okay. Okay, good. You did my job for me.
You're
Makes
welcome.
it all the more easier.
Yeah. We had somebody. Oliver was asking about what time frame it was, but overall, if you do have questions, please ask. But I think it was really, really straightforward. So,
great.
In terms of the James just said on our YouTube channel, very good information. So, and I do.
Great.
It was
Great, James.
it was pretty interesting. If you could have been here in the room on this side, Our marketing guy, who's very well at design, kept talking about how well the product was designed and how good the commentary looked, and just in general, how well
Oh,
everything is put together. And I think that's actually kind of a big draw of the program. You know, it does spell everything out for you. It puts everything into categories. Everything's color coded. You have the get outs that tell you exactly when to exit. And you guys did a great job designing this thing. So
thank you, Jeff. We tried to make it as simple as we can. I mean, the stock market, let's face it, is a very complex
you don't
business.
say. You don't say.
It moves in every direction that you could think of, and every day is a different day. So we tried to simplify it so the system does the hard work. The user just uses some common sense and follows the rules, and hopefully has a successful trade in their portfolio.
Okay. So in terms of getting it, and just in case you're not familiar with Metastock, it has been rated. It's a fully integrated software into Metastock, so you can use it to go in and scan for the setups. You can go in and look at the commentary. It'll give you exactly what your smart get outs look like. It'll tell you exactly what you need. And it is a very, very well designed. I like the fact that they went with color coding because it makes a lot of sense. You know, the green for the upward trends, the blue for the short term trends. In terms of kind of the pricing for this, it's only $99 a month. So generally, it's less than a really, really good trade, right? So it's $99 a month. You can pay for it on a yearly basis and get a little bit of a discount on it, $1,069. We are offering a special today where you will get your second month free. So if you're willing to pay for a month, we're going to give you an extra month. So instead of $99 next month, you'll pay $99 today. You'll pay for this month, you'll get next month for free. And guess what? That's going to run you to just about the end of this year, if you can believe that. So we do have training videos that are instant access that come as part of that. If you don't have Metastock, you should also do Metastock. We'll throw in a free trial of Metastock for you. With that, Metastock's been rated #1 for only like 25 years, like straight. So you should try it, see why. You can take care of that. You can do an order for that if you go to metastock.com/simplicitytradinga. If you have questions, you want to talk to somebody, give us a call. The phone number is 800-882-3040. Or you can also chat online if you're international and the 800 number doesn't work. You don't have to worry about the long distance. Just go to metastock.com/sales chat and we can kind of answer any questions that you've got. So give it a go, see how you like it. And it's been a very well received product for those people that try it out. So with that being said, any final thoughts, Nick?
I'd like to thank you, Jeff, and thank everyone at Metastock. We work together and we try to do our best, and everything seems to work out very good. Metastock is a great company, and I know William had worked very hard with Ryan when we were developing the program, and I reached out to him once and thanked him, but I'd like to just say over YouTube, thank you, William. Appreciate it very much, and thank you, Jeff. You've done so much for us. It's been awesome.
Yeah, William does a great job. He's an asset. In any case, all right. Well, I want to thank you for coming, Nick. You did a great job. We should have you on again pretty soon. For all of you that came from the audience, thanks for coming. I hope you learned something, and we'll see you at the next one.
Bye now.